So Federal Reserve for the US, the currency USD. Bank of Japan for the country Japan, the currency JPY. Bank of England for the UK, the currency GBP. European Central Bank for the Europe, the currency Euro. Swiss National Bank for Switzerland, and the currency CHF. And we have Reserve Bank of New Zealand, the currency NZD, and the country New Zealand. Reserve Bank of Australia, country AUD, country Australia, currency AUD. Bank of Canada, country Canada, and currency the Canadian dollar, which is the card. And then now we have central bank's mandate. So central bank's mandate is like the objectives of the central bank, or their duty or their responsibility as a central bank. Number one, the central bank is responsible for price stability. Number two, they're responsible for inflation rate target. And number three, employment rate, that is the labor market. They are in charge of making sure employment is good, unemployment is low, and employment is high. And then exchange rate policies. So they are the ones setting exchange rates, that is, exchange rate is the amount, like exchange rate basically, like if you want to change from franc CFA to naira, the difference between the currencies is exchange rates. So they are the ones in charge of setting exchange rates. Like you can hear maybe dollar is high compared to franc CFA. Maybe you can change $1 and it's going to give you maybe 500, 550, 600. That's exchange rates. They are the ones who actually control those policies. So price stability, central bank is there to also make sure that prices of goods and services is stable. Prices doesn't become too cheap and it doesn't become too expensive, because too expensive, when prices becomes too expensive, then that's inflation, and then when prices of goods and services becomes too cheap, that's recession. You might have already heard about inflation, recession, the country is in a recession or getting into a recession and all of that, and then inflation, price stability and inflation, they're almost the same stuffs. But then when it becomes too high, then now it's inflation. But then they're there to mandate prices to remain balanced, And then inflation. So inflation rate target. Normal inflation rate is 2%. You should always have that in mind. The target for inflation is 2%. So when inflation is on 2%, they consider that inflation is stable. But then once it goes too high, above 2%, that's over inflation, And then when it goes too lower than 2%, they call it getting into recession. So the central bank is there to make sure that inflation cannot stand at one level. It cannot just sit at 2%. So it constantly fluctuates, moving higher and lower at the same time, So the central bank is there to make sure it remains around the 2% target. Let's not get too high above 2% or too low below 2%. And all of this have its way which affects the market. We're going to get to that, but then just struggle to understand all of this point info. I heard you're going to understand how it moves the currency and how it affects the currency. So employment rate and labor market, they are there to make sure that people are employed, because when employment is good, or when employment is high, then that means the economy is going well, things are going well, and definitely investors will be persuaded to invest into that economy, because economy that have high employment is seen as a good economy to invest, save, So central banks are there to make sure these are on check. This is their mandate. They have just 4 mandates. And then they have their tools which they use to make sure that these things are on check. Their mandates are on check. So, but then now, you might be asking yourself that, but then how will you know what the central bank is looking at, So if they are looking forward to a high interest rate or whatsoever, but then you can go now to their website. You can just search on your Google Chrome or whatever, central bank like the Federal Reserve, they are going to the first website that always pops up is the official website of the central bank or the Federal Reserve. So here, this is for the RBA. So they say the Reserve Bank of Australia is Australia's central bank and derives its functions and powers from the Reserve Bank Act 1957. So 1957, its duty is to contribute to the stability of the currency, full employment and economic prosperity and welfare of the Australian people. It does this by setting the cash rate to meet an agreed medium-term inflation target, working to maintain a strong financial system and efficient payment system, and using the nation's banknotes and issuing the national banknotes. So again, the central bank is the one in charge of issuing banknotes. The government cannot print money. The central bank is the one who prints money. And they don't just print money, because if they print, when the economy has too much money, it's going to cause inflation to rise. And when there is shortage of money in the economy, it's going to cause underspending, which is going to lead the economy into a recession. So by then reading all of this news, you can be able to understand what they are looking at, what their objective is. If they say their objective is the labor market, they are ready to make decisions which is going to regulate or control the labor market. There might be high unemployment rate. The central bank now will have to work to boost employment. So now there are various ways which they use to boost employment. And now then, what this means, if the economy is too strong, central banks need to step in to prevent hyperinflation. If the central bank is too weak, central banks need to step in to prevent recession. As I said, when the economy is too strong, it leads to hyperinflation. That is, goods and services becomes too expensive. And then when the economy is weak, central banks need to step in to prevent recession. That is when prices of goods and services is too cheap. Because when it's too cheap, maybe producers will not be able to make a fair profit to run the business, and maybe everybody in the supply chain will not be able to make fair amount of profit when the good is too cheap. So at the end of the day, maybe the producers will have to close. Maybe retailers will not be able to keep on their business again, because you will not be selling something which you are not making gain, or you are not making enough gain to run the business. At the end of the day, you close. So central banks are there to make sure that doesn't happen, because it can crash the economy. So that's just it. If the economy is strong, central banks need to prevent hyperinflation and recession. And then now, this is actually one of the important things to take from this fundamental analysis: central bank tools. Central bank now have its tools which they use to control or regulate the economy. When I talk about regulate the economy, they have various sectors. They have their mandate, which is price stability, inflation, exchange rate policies, and price stability. So they use these tools to attain those objectives. So interest rate, when inflation is on the rise, the central bank now have to come in to regulate inflation, let inflation not get too high. They'll either use one of these tools to regulate the inflation. So have interest rates, raise it to control inflation and curb overspending, lower it to encourage spending and bolster economy. Then now have quantitative easing, implement QE to pump money into the economy, aka printing money. So, and then we have language. They can speak in dovish or hawkish tones to affect the value of the currency. So now, going back to interest rates. How does the central bank use interest rates to control inflation or to cut down inflation? So as of our last class, I was explaining that in the Western world or in the developed countries, most businesses originate from loans. Most businesses take loans to set up, and yes, like they are in debt. you know. So interest rate is going to play a great role of how much they are going to have at the end of the day to spend, you know. So let me say, if inflation is on the rise, that means there is a lot of money in the economy. People are getting paid very well. Employment is doing fine. People are employed, so there's enough cash in hand to spend. And then when people are spending, it's going to lead to a rise in inflation. It's going to lead in rise in prices of goods and services, you know, and that's inflation. So but then how will the central bank do to cut down inflation? They'll have to reduce the amount of money in circulation, make money to be difficult to get, you know. So when money is difficult to get, people are definitely going to cut down their spending, you know, because they'll not have enough money in hand to spend for leisure, or they'll have to bargain prices, you know. So and a lot of bargain is going to cause the prices to drop, you know, even if it's small. But then when everybody's coming and bargaining, there is not enough demand as it used to be, you know. Suppliers, retailers, they'll be forced to maybe reduce prices a bit to encourage, you know, to encourage spending, you know. So central bank can raise interest rate to cut inflation by increasing interest rate. When you increase interest rate, money becomes expensive. How will money be expensive? Suppliers, business owners, CEOs, that they are in debt, they'll have now less amount of money to spend, you know. Maybe they'll have to fire their workers, or maybe they'll have to reduce salaries, you know. Because let me say you took a loan. By the time you took that loan, interest rate was at 3%, and the total output of your business is 5%. And now interest rate have climbed to maybe 4%, 4.5 or 5%. You discover that you don't have enough money to pay yourself and to pay your workers. So now you have to normally struggle to control the situation. Maybe you have to fire some people, or you have to cut down their salaries, or sometimes business owners will not even pay their workers because they don't have enough money in hand, you know, which is going to cut down spending. If you do not get paid, this month, you will definitely cut down your spending, you know, because you will not have money to spend, and you will not have money to spend, basically. And when then unemployment is going to increase, you know, which is actually going to cut down the way people are spending, and as a result, inflation is going to drop. So that's just how they use interest rates to cut down inflation or boost inflation. And then vice versa, when inflation is too low, you know, that is getting into recession, the central bank has to raise inflation, has to make prices of goods and services to increase, you know. Now they'll cut interest rate. They'll reduce interest rates. Maybe it was at 5%, they can reduce it down to 3%, which is going to encourage borrowing, you know. People who have business ideas, who were looking for money to maybe like establish their business, you know. The ones who are looking for money to expand, they will now see that as a good period for them to go and take loans, expand their business, and which is going to which is actually going to encourage spending, you know, because when people are employed, they are going to spend more. And then now maybe they are going to actually increase salaries, you know. There are going to be some bonuses and all of that, which is going to actually give enough cash to the citizens, and they will now be able to spend, which is actually now going to raise inflation, you know, because now there will be less bargaining, there will be high demand and all of that, which is going to increase prices. You know, when there is high demand for a certain product, it causes prices to go up, you know. If you're selling something and there's high demand and people don't bargain the prices, you just say the amount and they just pay, you'll be persuaded over time to increase your price a little bit. And that's how the central bank does to raise inflation or raise prices of goods and services. And then now have quantitative easing. They'll implement QE. What's quantitative easing? Quantitative easing is printing money, you know. So they can print money and pump into the economy to raise inflation, and they can reduce money in the economy to bring down inflation. Now, how do they do this, or how does this affect the economy? But then, how does the central bank implement quantitative easing? So you must have heard about government bonds. Central bank have assets. They buy assets, they buy big real estate, they buy bonds, they buy shares from companies, and all of that. So when they want to implement quantitative easing, that's pump money into the economy. They'll basically print new money that have not been in circulation, and then they'll go out with that new money and buy stuffs. They can buy lands, they can buy real estate, they can buy government bonds, but mostly it's government bonds. They really use government bonds more than the other assets. So they can come out and say, okay, they are reducing their holdings of government bonds. That is they are selling. No, that is when they want to actually remove the amount of money in circulation. So they can come out and say they are buying government bonds, they are buying shares, stocks, real estate. So now they'll print money, new money that was not in circulation, and they'll go out, they'll start buying stuffs. In the process now of buying stuff, that's actually giving money into the economy, because they'll take new money and they'll come and buy something from you. Now you'll be with cash that was not first of all in circulation, So that's how they pump money into the economy to boost the economy. And then now when they want to reduce the amount of money in circulation, they will now go out and start buying. They will now go out and start.
How?
So okay, continue. If when they want now to reduce the amount of money in circulation, I beg open that door for Jack and Jack.
I beg, I saw one student get some course with me, so attend. That thing will put that website location. I know say nobody don't show me. That man say we'll put that location.
Man, what did he say? Excuse me.